Have you thought about buying covered call funds, maybe specifically covered call ETF funds or another type of covered call fund? In this video, I'm going to be sharing with you the pros and cons of ETF funds. Hi, I'm Camille Gaines here, and on my website, retirecertain.com, I write about and talk about my investing adventure since I was in my early 20s, which as you can see was a long time ago, as well as creating multiple income streams over the past 15 plus years along with my husband after stumbling into early retirement. In this video, I'm going to cover what I've learned about ETF covered call funds over the years, the pros and cons of owning those. If you are interested in this type of information, be sure to subscribe to my channel and click that little bell so that you get notified when I post a new video. All right, so covered calls, as you probably already know, are a way to generate extra income from stocks. I've done some other videos on this, so make sure you check that out if you're new to covered calls. I love covered calls, but I say that with a warning that it's only suitable, covered calls are only suitable for someone that is comfortable with stock market risk. All right, so the very first pro that I want to mention, and I'll cover those first, is that covered call ETFs or covered call funds of any type, really, they're very, very easy to do. All you do is choose the fund and purchase it in your brokerage account. Boom, you're done. No analyzing which securities to buy, no figuring out which call option to sell, nothing. You just pick out the fund, buy it, and you're done. Boom. All right, the next thing I like about ETF covered call funds or any type of covered call fund is that they generate much higher income than dividends. Dividends are incredibly low. You've probably heard me say here that it takes a lot of capital to generate any meaningful income off of dividend stocks. And while there are some stocks that yield 6, maybe 7%, the higher up you go with that, the more risk you're taking. And the dividend aristocrats are yielding, very minimal right now. So dividends require a lot of capital for the amount of money that we make on them. That's why, in general, I love covered call strategies, all right? But I'm not so sure that I like covered call funds. And here's why. This leads me right into the cons. Number one is that you forfeit a lot of the upside with covered calls, period. Now that's not just a fund. That happens if you're writing your own covered calls as well. So when you sell a covered call, you've got to sell the stock at a certain strike price should the call option get exercised, and often that results in forfeiting some of the upside on the stock itself, if it should incur a capital gain. I always like to say covered calls are a bit like a bird in the hand versus in the bush, because you sell the call option and you get the income, period, even if the stock goes up or down. With capital gains, they're less certain than that option income you get from selling a call. Having said that, we do, as covered call writers, have to forfeit some of the upside on that capital gain, that increase in value, if the stock does have that before option expiration and the option gets exercised, which it will if it goes above the strike price. The next con about covered call funds is that you're really limited with high volume securities, either stocks or ETFs. So say the ETF fund that's selling the covered calls is selling the covered calls on ETFs. You're really limited, and here's why. Funds manage millions, billions of dollars, okay? So a lot of options, either on ETFs, or I should say both on ETFs and on stocks, have really, really low volume. So just imagine a fund manager trying to sell covered calls on these low volume options. It's just not going to happen. They can't do that. So funds are restricted to covered calls that are written on extremely high volume options. And I like to say this is where individual investors like us really have an edge over Wall Street. Oh, it used to be Wall Street, the institutional funds, right? The institutions. And that is that we can sell covered calls, maybe 3 covered calls or 5 covered calls, and generate meaningful income on a very short-term basis. And that will generally generate more income than we can get from something like a very active high volume option on something like SPY or something like the Q or another type of very, very high volume ETF. It's just that you get a higher return on those lower volume stocks usually. Now, granted, or ETFs, I should say. Now, granted, it's harder to get them filled, right? But there's no doubt that the income generated from covered calls on individual positions is much higher than the funds are able to do. And that, I love it when I find something that we have as individual investors. It gives us a little bit of a leg up on the institutions. And this is certainly one case. The next con about covered call funds is that many of them use leverage. Okay. And leverage, I've done another video on how I like to use leverage in investing, but leverage for funds makes me a little nervous. They're just so much more volatile. I'm not saying I would be 100% against it. I just think it's something to be aware of and to be really, really careful of. And let me back up just a little bit and say that this particular video was inspired by someone on my channel asking me what I think about QYLD, which is a very, very popular covered call fund, all right, ETF fund. Okay, so the next con about funds that sell covered calls are the fees are high, right? Not always, but a lot of the times they're high because it's more work to sell covered calls than it is to simply buy SPY and let it go up. So because of that, there are more fees involved. And for individual investors, the fees and commissions have gotten so incredibly low that they're probably not comparable to ETF funds. I haven't looked lately because I don't buy ETF cover call funds. But having said that, it's something to be very, very careful of because I know for sure that in the past when I've looked at them, some of them have had very high fees. The next con with covered call funds is that they incur taxes. Now, this depends on the fund structure that is going on and whether or not they pay out all the income from the covered calls, but generally covered calls income on the option itself is a short-term capital gains, and short-term capital gains get netted with long-term capital gains, and then they're added to your ordinary income. So that ends up being taxed at your highest rate. Now, I've always got to say, I'm not a CPA. Please, I'm not giving tax advice here. And I'm probably often get things wrong about taxes when I mention it, so don't leave any dirty comments. That's been my experience with taxes on covered calls. Of course, we're going to have that whether we're in a fund, an ETF covered call fund, or whether we are implementing covered calls ourselves, as is the next con, and that is simply the risk from the stock market that we have when we sell covered calls. It's easy to get really excited about the lure of something that delivers a 2 to 3% return every 4 to 6 weeks, which is doable, especially during volatile times on covered calls. It's fantastic. It's hard to beat that. But having said that, all the capital that you have in the stock market for those underlying assets that you're selling the calls on is subject to stock market risk. So I always like to begin everything with saying, define how much risk you're okay with taking before making any investment ever. And then from that place, choose the investments that work for you to get the return that you need to live how you want within that acceptable risk so that you can be happy. Remember, retire certain.